guys, welcome to Money Control. I'm Karunya Rao, and today it's going to be all about investing abroad. What are the basics? What are the checklists that you need to have in handy with you while starting out your journey in foreign markets? Joining me in conversation today is Sandeep Jethwani of Deserve. Thank you so much, Sandeep, for joining in and for taking time out.
Thank you so much for having me, Karunya. It's an exciting time to be here and talking about this. It's a very exciting and interesting topic, and I'm looking forward to this conversation.
First up, I'd like to know why one typically invests abroad. Of course, diversification is one obvious answer, but what are the big pluses of expanding your horizons and investing your monies in foreign markets?
To my mind, there are two reasons why people make investments outside of India. One is that we have some defined requirements for the capital that we send outside. A lot of this generation of folks want to send their second generation or children outside of India for education. So that can be one thing. It can be about medical emergencies and so on and so forth. So that is one part. And the second is if I want to diversify my portfolio and not have all the money in Indian assets. Uh, I think when we look at the first thing, like if I have to, let's say, if I have a child whom I want to send abroad for her education, say 5 years from now, I need to invest those monies into instruments which will be available to me 5 years later when I have to pay the tuition fee at that point of time. Whereas if I'm now looking at diversifying the money out of India and all my current portfolio is in Indian assets, I need to look at globally what are the interesting options available, which will give me return and also give me that currency and geography diversification that I'm seeking. Uh, Now, from a perspective of opportunities, and frankly, like we believe that if in India we have close to 25,000 unique opportunities across bonds, stocks, mutual funds to select from, the moment you move overseas, this number multiplies to 10 to 15 or 20 times of that, right? And therefore, having a right framework around how to choose these instruments is very important. But at the very high level, there are options available from direct stocks to bonds to funds, to hedge funds, to structured notes, and so on and so forth. And maybe we can talk in a little bit detail about some of these. But the basic concept is there are multiple options available, and we have to be thoughtful about how we allocate money.
Okay, and for beginners, how do you typically go about starting your journey in investing abroad? Let's say somebody who's already invested in India and wants to now take the next step. What do you typically recommend a person like this to?
Yeah, I think it's a great question, Karunya, because I think a lot of the basic principles that we apply to investing in India also apply when we invest overseas. For example, the one concept which all of us have internalized is the concept of SIP or systematic investing plan, right? Especially when it comes to mutual funds. I think a similar approach also needs to be applied when it comes to your overseas investing. A lot of times I find that people are looking for just the right amount of right point of time where they want to transfer the money overseas. And quite frankly, it's not about picking that date when the currencies are the right price to transfer some money overseas. So what my recommendation is that think of your building your international portfolio as an SIP to begin with. Typically, an international portfolio should be around 10 to 15% of your domestic assets. So let's say if I have saved up, say 10 lakh rupees, close to about 1 to 1.5 lakh rupees needs to be in global assets. Second, that this also needs to be spread out over a period of time. So I need to ensure that I'm sending out this money over a period of say 3 months or 6 months or whatever period I want to do this SIP over. And the money goes out systematically in that period of time. And thirdly, when it comes to what kind of instruments should beginners look at? Look again here. The idea is that there are multiple number of options, and therefore, as a beginner, I would say identify high quality mutual funds, high quality fund managers, and allocate money to them rather than trying to self select a lot of these complex options because there are options listed in the US, then there are European stocks, then there are emerging market stocks, and so on. And it's quite frankly very hard as an individual investor, beginner especially, to allocate. So I would say pick a global mutual fund or an index fund that you can put money into on an SIP basis over a period of time.
When it comes to investing abroad, we often hear about LRS also, liberalized remittance scheme. Can you Talk us through what exactly that entails, and is it any better or any different from the other avenues?
Yeah, so there are two ways that anybody in India can invest overseas. There are a bunch of mutual funds in India that you can put money into. And from time to time, SEBI defines the limitations on what kind of capital can go into those funds. So that is one option. The other option is I've actually sent the money overseas. So the money leaves your bank account, gets converted into US dollars, and hits a foreign bank account that either you've opened or that of a global fund. Now, that is called the liberalized remittance scheme, under which any individual can send out $2.5 lakh or close to $250,000 overseas for the purposes of investments. But this, by the way, this liberalized remittance scheme also includes all other ways for which money or reasons for which money is sent out. For example, if I send money out for my child's education, or if I send money out for my travel, or if I use it for any medical expenses, all of this is covered under this $2,50,000 limit that we have. Uh, Over the last year, let's say I'll give you an example for the financial year 2021-22, Indians sent out close to $19 billion under this LRS limit, but only $747 million of that was towards investments. The rest of the money was used for education, for travel, for various other things. So this liberalized remittance scheme is a way for us to transfer money overseas, but all of us here should remember that that includes all the reasons for which we transfer money overseas and not just investments. Investments is one option provided to folks like us, which we can use from this pool of capital.
And what about managing your monies? If, let's say, I made a profit on my investments abroad, or even if I want to write off a loan, how does that work when I have to file my income and my earnings back home in India?
That's again a great question, Karunya. Depending on the nature of the income, you have to file for taxes here in India every time you book the income. For example, if I have invested into the units of a mutual fund outside of India, when I sell those units, I have to pay capital gains tax in India if I have made a gain. Or if I have made a loss, then I can take the benefit of that loss here in India against my other capital gains. Similarly, if I receive interest income overseas, then from a bond, let's say that I've invested in, then I have to pay tax on that interest income here in India. So I think all of us here should realize that all the gains that we make on the monies that we send out, we need to be reported here in India and paid taxes on. And frankly, it's important, therefore, to involve your chartered accountant in this process to ensure that you're reporting it and filing it correctly. The other thing that I would strongly recommend is for all of us to look at instruments which we can hold for a long period of time, because that way the money that we have invested compounding over a period of time, and we are only paying tax maybe many years later when we are selling it. Often trading in foreign stocks is actually more complex because you end up booking and incurring capital gains and losses, and then accounting for that here in India becomes slightly more tricky for most big investors who are beginning to create a portfolio overseas. So my strong recommendation is look at global funds, where all of this accounting and processes become much simpler.
Okay, and do I need to open a separate account for these transactions as well? Are there any specific different accounts from what the trading account or the bank account that I use?
So you have a bank account in India. You send money from that bank account to either A, an overseas bank account, or B, the account into which the investment is happening directly. For example, if you have an account in India from which, say, you're sending out 10 lakh rupees converted into US dollars, you can either create a bank account, say, in Singapore and send it to that bank account and make investments from there, or you can directly remit this money to the fund that you are investing in. However, what you need to keep in mind is that if you're investing directly into a fund from this capital, whenever you withdraw that money will come back into your Indian account. And then again, you will have to send it back out under this liberalized remittance scheme yet again. So our advice is create a foreign bank account, fully disclosed here in India. Send money to that and make your investments from that, or at least make sure that the investments are linked to that bank account. That way, whenever the capital is coming back, it goes back into that bank account, and you have the flexibility of reinvesting it overseas.
Okay, but net, I mean, what are the big do's and don'ts when starting your investing journey in foreign markets?
So I'll start with the don'ts because often I think that gives everyone a lot of clarity. Our strong recommendation: don't get into individual stock trading when you begin your overseas investing journey. Why? Because the number of stocks available there are much more, and is much complex, much more complex. Secondly, just don't invest on basis of a theme, or let's say, something that sounds attractive right now. So, for example, I saw a lot of investors invest in tech stocks last year, whereas there is an opportunity to invest in the broader index. So don't get carried away with an individual theme. And third, keep an eye out for costs. Costs are very important at every level of the transaction, which is, you when you transfer your money, ask your bank how much conversion rate are they charging you, and finally where you're investing, what the brokerage rate is, and so on. So three things in terms of don'ts. In terms of do's, I think strongly look at good quality fund managers. There are great fund managers that you can back outside of India, and carry out a disciplined SIP based approach rather than a ad hoc lump sum investing, which often I see a lot of people do.
Okay, so looks like it's fairly simple. Do you suggest somebody to go via, a broker route, or is there anybody to assist you in this journey, or should you do it directly? Is it simple and easy to navigate?
The process itself is not that difficult, Karunya. I think the critical place where you need help is which instruments to invest in. And for that, I strongly recommend, again, if somebody is a beginner and is not doing their own deep research, to look at wealth managers who would advise them on this journey. And I'm sure there are wealth managers in India who are doing a good job around this. So I would say start with a handheld approach, build your confidence, and once you're sure that you can do it on your own, that is the time you should potentially figure out your own DIY based investing.
Okay, all right. On that note, Sandeep, thank you so much for taking time out and talking to us about the basics of investing abroad. Great to get in your perspective and having you on board.
Thank you, Karunya. It was a pleasure being here.